Hey, you guys, I am going to work a tax calculation problem with you. I'm actually going to work three of them. So I want you to do all three of them, even if you don't watch the whole video, because then we're going to also talk about marginal rate versus average rate, and also progressive, regressive, and proportional. So this is kind of like a lot of things in one video. I'm going to flip over to my document camera here. Okay, this is from your notes. So we talk about the progressive structure of our federal income tax system, and hopefully by now you know that that means not only does the absolute value of the tax dollars go up as you have more taxable income or a higher tax base, but the percentage, the tax rate itself goes up. Um, so first of all, just real quick, I said that is unlike, for example, something you should be familiar with, like sales tax. So sales tax, whether you buy a $4,000 car or a $400,000 car, the rate remains the same. I know that the absolute dollar amount of tax would increase, but the rate, like in Tyler, we have an 8.25% rate, right? Okay, let's go back to our federal income tax system, which is progressive. And we're going to start out with Alan, who is single. That matters, remember, because that tells us which filing status we're going to look at on our tax charge. And we're looking at 2024. So you'll have this sheet on your exam. You just have to be cautious about which year did she tell me and which filing status am I. In this case, I just said Alan is single. You also need to know what the differences are in these filing statuses really well, because I may not just tell you, head of household. I may say, Alan lives with his 7-year-old dependent daughter. The daughter lives with him more than half of the year. And from that, you automatically know, oh, that's head of household. So, okay, in this one, we just know Alan's single. He has $30,000 of taxable income, which means, remember that suppose all of this came from his salary would be more than that because you always get to deduct at least the standard deduction. So Alan probably had a salary of 44,600. He's taken his standard deduction, and that has left him with a taxable income. I go over that very slowly to tell you that because sometimes on exam questions, I'll give you a salary, and sometimes I'll give you taxable income. You're going to come up with two different answers depending on what I gave you. So you need to read the question really carefully. So, okay, for 2024, remember, I said I think of all of these tax rates like individual buckets. The first 11,600 of income a single person earns is taxed at 10%. And then from 11,600 to 47,000, so the next 30 something thousand is taxed at 12%. And then the next bucket, so on and so forth. So you can't ever just say, oh, I made 100,000, easy peasy, we'll multiply it by 24%, because this 100,000 is taxed at all of these different rates. So Alan had what, 30? Yeah, 30 of taxable income. The rates say if it's over this amount, but not over this amount. So his taxable income is going to fall on row 2 here because it's over 11,600, less than 47,150. Use this line. And then here is the formula they tell me to use. We're going to take 11,000, I'm sorry, 1160, 1,160 plus 12%, it says, of the amount over 11,600. Of what amount? The amount of your taxable income that's over this. So our total taxable income was 30,000. So 30 minus this 11,600, this is the amount that's over 11,600. I want you to stop, if nothing else, and make sure you understand why we're doing this. What these sheets are telling us is they've already figured out the amount of tax on all the buckets before this. In Alan's case, there was only one bucket before this, the 10%. So in his first $11,600 of taxable income, he owed 10%. That's where they got the 1160 from. Then on anything between here and here, he's going to owe 12%. How do we figure how much is between here and here? Well, take his 30,000 of taxable income minus the 11,600. That's what we're doing there. And for some reason, a lot of students just really struggle with this. So make sure you practice it. So 30,000 minus 11,600 is 18,400. That's the amount that gets taxed at 12%. So that times 12% is 2208. Plus, we've got to add this 1160 on that first 11,600 of income. So 1160 plus 2208 is 3368. That is how much tax Alan is going to owe on 30,000 of taxable income. So what I've done here is break it up into like the buckets, like I call it for you guys. The first level of income was taxed at 10%. The second level was taxed at 12%, and it would just go on. So if you want to, you can shut the video off and work out these next two examples. I'm going to do the same, and then we'll talk about, like I said, progressive, proportional, and I'll point out a couple of things for you. Okay, again, because this is video, you can stop it at any time, but I went ahead and worked out examples 2 and 3 and want to compare some things with you. In the first example, Alan had $30,000 of income, taxable income, and he ended up owing $33.68 in tax. Second example, he had 60,000 of income. He ends up owing $82.53. And the third, so he's doubling his income each time, right? 30, 60, 120. And he ends up owing $21,842.50. So we can tell this is a progressive tax rate because he's only doubling his income each time. But look, he is more than doubling the amount of tax that he owes. So it's not a proportional, or it would be proportionate. It would be the same rate each time. Okay, another thing I wanted to point out on this page, that for exam purposes, when you're just scribble scratching and whatever, like I'm doing in class, you can do whatever you want. But when you're filling out an answer in class, I want dollar signs if it's a dollar amount, commas where they're supposed to be, and if it's cents, then carry it out to cents, just like you do in other dollar amounts that you list. So this would not be correct. I don't want you to put 21842.5. If I asked you how much you owed in taxes, or your client asked you, you wouldn't answer them 21842.5. You would say you owe $21,842.50. So be careful about how you write that out. One thing that we will see on our tax returns, however, is that we always round to whole dollars. So his tax here would really be $21,843. I wouldn't count off if you did this either way, but just so you know, as a matter of practice, we round our amounts to whole dollars on the tax return. Okay, that's the progressive system, which is what our federal income tax system is. A lot of taxes go based on a proportional method, and you can read about this in the book. But that means, like I just mentioned before with the sales tax, while the absolute dollar amount of the tax might go up, the rate itself stays the same. So in this example, what do we have? Let's see, Bill has $10,000 tax base, and if it's a 10% tax rate, he would owe $1,000 in tax. Well, if he has a $500,000 tax base, but still a 10% tax, he'd owe $50,000. So look, yeah, the absolute dollar amount that we owe went up, but the rate is still 10% no matter what your tax base is. So it's proportionate to the tax base in that example. And then there is a regressive tax, which sounds crazy, but the more you earn, the less tax you owe. Not in absolute dollars, but the rate. One example of this would be your Social Security taxes. So most of you guys work. If you look at your paycheck, you can see Social Security and Medicare taxes being taken out of your check. You don't have to memorize this now, but the Social Security amount is 6.2%, and the Medicare amount is 1.45%. So a lot of people say, oh, FICA taxes are 7.65%. But there's a catch. Once you earn a certain amount of income, they stop taxing your Social Security. This is inflated every year. So I think for 2024, it was 168,600. Don't quote me on that if that's off a little bit, but it's somewhere around there. And what it means is If I made $200,000 in income, only the first 168,000 would be taxed at Social Security. So average wise, if I take that tax divided by all 200,000 of what I earned, my rate would actually be a little bit less than 6.2%. And then say I made $1 million, still just the first 168,000 is taxable for Social Security purposes. So average wise, my rate would be way less. But we know for Medicare purposes, it is always 1.45%. So this rate is a proportional tax, and this one is a regressive tax. So sometimes you have to make sure you're not just reading the definitions, but you really need to work a problem with it to make sure it makes sense. And that's where I see some students kind of struggle on the exam. I'll give you a problem and say, okay, which rate is it? And everybody's like, I don't know. I can tell you the definition, but I don't know how to do it in practice. So make sure you're working on that. We will not cover corporate stuff, rules in this class since it's an individual class, but I do want you to know that as of right now, the corporate tax rates are a flat rate, which is the same as proportional, and it's a flat 21%. That is written into the code permanently with this Tax Cuts and Jobs Act, so it went into place in 2018. But it's only as permanent until the next president and the next Congress, right? Congress can change this anytime they want to. So we'll see what happens. Okay, that was tax rate structures, regressive, proportional, and progressive. Now we're going to look at types of tax rates called marginal, average, and effective. The marginal rate is the one we use the most in tax planning. That sounds like a good exam question to me. So let's look at why and what that means. Go back to your tax rate sheet and suppose I'm your client and I come in and I say, hey, this year I made I'm single and I made $242,000. Just because I got a really big bonus. I don't normally make that much. Next year, I'm only going to make $190,000. So I made 242 this year, and I'm thinking about selling this rent house that I have. It's December now, and I tell you, does it matter? Should I sell that rent house now, or should I wait till next year? Are there any tax implications? Well, what we know is that if I earn another $1,000 or $1,700 of income, it's going to bump me into this next 35% bracket. That is called our marginal rate. It means the next $1 of income that you earn or the next dollar of deduction you could find. What rate would it put you in? And so in this case, if I earn a little bit more money, it's going to push me up to this next one. And in that example, I might tell me or my client, hey, don't sell the house this December then. If you know you're going to be in a lower tax bracket next year, maybe just wait 1 month and sell the house then. So that's why the marginal rate is the one that's mostly used for tax planning purposes. You can look at that example, for Cecilia. So now let's look at the average rate and the effective rate. Average rate means after you figure up all your taxable income and all of your total tax, how much on average did you end up paying? So remember, this is the Allen problem that I just worked where he earned 30, 60, and 120. And then here's his total tax. Let's look at Allen's marginal rates. Remember, this was 2024 and he was in the single bracket. When he earned an average of $30,000, if he earned one more dollar of income or found a dollar deduction, he's still going to be in that 12% bracket, right? That's his marginal rate. When he was in this one, the $60,000 that he earned all the way up to 100, he would be in the 22% marginal. One more dollar of income is going to get taxed at 22%. And then when he made 120 of taxable income, he was in the 24% marginal rate. But see, before I do it, this is just kind of common sense. Test yourself, problem solve on your own. What are the average tax rates? I'm going to stop the video. You do the same thing, figure it out, and come back and check your answers with me. Okay, a couple of things here. Make sure you got the right answer, but also let's talk about decimals and rounding. If you're doing homework in Cengage, Cengage will be very clear and tell you, don't round to intermediate calculations or round to 1 decimal% or whatever. So let's look, I want to look at this second one. I said the total amount of tax Alan had to pay was $8,253 divided by 60,000 of taxable income, and he got 13,755. We need to turn that to a percentage. So we just go, move our decimal over 2 times. Why did I do 13.8 instead of 13.7? Because if I'm rounding to only 1 decimal place here, that 5 makes my 7 bump up a number. If this had been 0.13744, then I would have left it at 13.7%. So just make sure on exams and Cengage homework, you pay attention to how they're wanting you to round, and make sure you're rounding appropriately there. So your average tax rate is important, not so much for tax planning, like for yourself or with clients, but this is what Congress and economists need to look at as a whole, right? Because if Congress makes a law to raise taxes because we're $37 trillion in debt in our country, what is that going to do to those of us that work? We need to look at, on average, how much of our income every year goes to paying taxes. And notice how average is usually less than the marginal rate because not all 120 of that was in the 24% bucket. Some of it was in the 12%, 10%, 22, 24, right? So it averaged out to only 18% there. Okay, and then finally, we have the effective tax rate. This looks at economic income. So y'all know from your econ classes that economics really looks at a change in wealth. So here's an easy example a lot of people will give you. I live in a house that I've lived in for maybe like 8 years now. The value of my house has gone up drastically, as has most people's in Tyler or Texas or the whole US. Real estate has appreciated in a lot of places the past few years. So economically, an economist would tell me that I'm better off. I own an asset that's worth a lot more now than it was worth 8 years ago. But for tax purposes, I don't have that wealth in my hot little hands right now. I would have to sell my house to have the money from it. So for tax purposes, we don't usually look at economic wealth. We look at what we call realized gain. Did you actually sell it and get some money or something else for it? So the effective tax rate, I don't have you actually do calculations for in class, mostly for one reason. If you go to work at an accounting firm, the software will spit out the client's average tax rate at the end of the tax return, but usually it calls it effective rate when really it means average. So I don't want anybody to be confused by that if you're going to work for a firm or already do. So I don't usually have you do calculations on that, but I want you to know what it is. Okay, hope that helps with all your tax rate stuff.